Welcome, everybody, to another edition of ATL Alts and the Asset Back Podcast. This is your host, Andre Sindate. I am also an advisor and head of alternative investments for Gramercy Park Wealth Advisors and GPWA. We're a hybrid broker-dealer based in Nashville, Tennessee, with my office based in Atlanta. And as you know, on the ATL Alts and Asset Back Podcast, and with our new Endurance X platform, we have the opportunity to interview and speak with founders and leaders at leading alternative asset management companies. And so today I'm delighted to be joined by the president and chief strategy officer of one of our clients, the Oak Companies. So Ray Davis, I'd like to welcome you to a dual episode of the ATL Alts and Asset Back Podcast. We're really excited to work with the Oak Companies, and there's some really fascinating and interesting things that you guys are doing in real estate and real estate credit, to be specific, which was why we were excited to have you guys decide to partner and elect to partner with us to be a part of what we're building at Gramercy Park Wealth Advisors and Endurance X more specifically. So today, what we wanted to do is use the next 45 minutes to do, the why of the Oak Companies and allow you really to tell that story. So with no further ado, Ray Davis, welcome to the show, and glad to spend some time with you today here on Friday afternoon.
Andres, thank you for having me. It's a pleasure to be here. I'm excited to talk to your team, and hopefully I can provide them with some education and a little bit of, I call it manager insight, things that they should typically look for in a manager, whether it's Oak or somebody else.
Yeah.
And let's get going.
Yeah, let's get going. Obviously you see on the screen, we're going to use a format today where we kind of use some slides to help folks that are watching. Obviously our content is all over YouTube on our ATL Alts and Asset Back YouTube channels, but it's also available wherever you get your podcast. But there's some important disclosures here that folks want to be mindful of before we dive in. Again, we are not going to be talking about securities. We're not offering financial advice today. We're not offering legal advice. We certainly would recommend anybody that is watching the content to consult with a qualified professional before you make any investment decisions. So to frame this up, Ray, there's 4 questions here on the screen in order that we would ask. And so let's follow this format. I like to ask my guests to talk about, their backstory. And obviously, the follow on to that is, what does Oak do? So, tell us a little bit about you and how you kind of got to this role of president, chief strategy officer of the Oak Companies, and then tell us a little bit about your business.
Yeah, sure. So thank you, Andreas. I appreciate it. And as we go through these, I've got corresponding slides that you can reference. So again, guys, my name is Ray Davis, president, chief strategy officer for Oak. We started the company we bought the company after COVID from the predecessor founding group who really got in trouble because of COVID. What we bought was 2 100% defaulted portfolios that we did not underwrite, that we did not lend on. But if we didn't buy them, the investors stood to lose a tremendous amount of money. And I had about 30 million of friends, family, and associate capital in these funds. So we just went ahead and bought them out. That was a different company. That wasn't the Oak Companies. But from that point, we've grown the company. We turned around those portfolios and started growing from that point to build what is now a small balance sheet commercial real estate lending platform that primarily services insurance companies, foundations, and endowments. But we have a lot of RAs who have brought retail investors to us, roughly 8,000 to date. So the team's done a great job growing, and our RIA partners they've been a tremendous help of helping us not only grow during those turnaround days, but from that point on as well.
Yeah. Well, and obviously that's a big audience for us at ATL Alts, and the genesis of building Endurance X was really to support that independent advisor that has left a big wirehouse, left a big regional broker-dealer platform. He or she and maybe some team members have elected to set up their own wealth management practice. And when you do that, right, you're starting your own business, and you have the ability to bring on managers and investments, and you can partner. And there's a lot of different models out there, clearly, for folks that are listening that know that. But one of the things that we are fundamentally believers in is that small can be beautiful. And one of the things that we equate what we're doing on the alternative side at our organization, Gramercy Park, is if you think about the public markets, you have the mega caps, you have the large caps, you have the mid caps, you have the small caps, and then the micro caps. And when you think about a public equity exposure allocation for an RIA, I think a lot of people would understand that, right? And you'd say, well, mega caps would be your 7 to 8 mega companies, the Metas and the Googles, et cetera, of the world. And then when you go down to small cap, I think there's some RIAs out there, probably a fair number, that would say, hey, I think active management still works there. Emerging markets is another example. And so when we think about alternatives, we want to be known as a firm that is out there looking for the small and mid cap manager, or even the emerging manager. And that's not to suggest that these firms aren't going to grow. I mean, you guys have grown substantially, but we really feel like managers that are in their assets, that are living and breathing in these communities, they're touching these assets on a day-to-day basis, is a very different organizational setup and business and motivation and alignment with investors and RIAs than, say, a traditional big Wall Street asset gathering model where things are done more on a quarterly basis, to hit quarterly profits and quarterly numbers. And so talk a little bit about the business of, setting up Oak, when you talked about its constitution, like what was the vision for the management team when setting it up?
Yeah, this is perfect. Flip to the next slide, and I think I go right to it. So let's talk about the business, guys. So we're, like I said, Andres, we're a structured commercial real estate lending group. But what's interesting is there's one platform that covers all of the sponsors' needs. We were engineered to serve as a sponsor. So what do I mean by that? So we originate first lien senior secured income producing commercial real estate. So you've heard that before. What we do is we focus in the $2 to $20 million space. And the reason we do that is that's middle America. So Blackstone, just as you just said, KKR, Apollo, they can't come down here, right? So they can't come down here. They can't drive efficiency. So that does a couple things for us. One, that is middle America. That's the 200 unit apartment building, the grocery anchored retail shopping center, the Amazon last mile, the mobile home park, assisted living. These are the real estate, commercial real estate properties that make America run. These are not the $200 million buildings that Blackstone are financing. So when things go bad, these are the assets you want to own because these are the assets that people need. So that's why we're in this $2 to $20 million space, heavily fragmented. The big guys can't come down here.
Yeah.
And so what do we do within that space? So we do your typical acquisition loan. That's just buying a commercial real estate property. We do transitional bridge loans, which is, hey, I want to renovate the 200 apartments for highest and best use, charge more money. We do special situations. I told you we started the company by buying the 2 defaulted portfolios. Well, we still help sponsors buy defaulted assets. We bought a COVID era asset, COVID vintage, with one of our sponsors. It was a $40 million assisted living center in the northwestern part of the country. He bought it for $14 million. We closed on it in 40 days. And not only do we make a yield, we make some backside upside with it. And we're very used to these type of assets. So our investors get to share in that kind of thing. So no bridge lender really focuses there. And then we own an agency lender called Johnson Capital Multifamily. So we can do FHA and HUD. So if you think about this platform as a real estate borrower or as an investor, because we're talking to the RIAs, we can handle every aspect of this category, the $2 to $20 million, and we can handle it in good times and bad times because we both know when times are great, every manager looks like a genius.
Yeah.
What happens and how are you built for the times when things go bad? Hence, we started during COVID, right, by buying those bad assets. So it gives the platform and us a very unique competitive advantage by being able to cover the whole life cycle of a property.
Yeah, and
everyone again is senior. Sorry.
No, I was going to say, and some of the structural advantages that we'll probably get into, because clearly we saw a shift as we talk about asset allocation, we saw a shift as RIAs, right? After, the GFC, we saw a lot of traditional financial institutions that were obviously very levered. They were going through a lot of regulatory scrutiny. They were restructuring, and we saw this explosion of private credit, and we saw all these non-bank lenders emerge, and the wealth channel, along with a lot of other big LPs, went into private credit in a big way. I always felt like, and I remember telling Brian, my partner at Gramercy, like, I feel like asset-backed and asset-based and hard asset-backed. We talk today about halo investing, hard asset, not going to become obsolescent, right? So these notions now we kind of take for granted, but that's not what was happening in the wealth channel in 2012, 2014, 2016. It seemed like everybody was rushing into private credit. But I want to stress some of the things that are on the slide for the RIAs that are listening, and allow you to sort of comment. When you talk about the loans you're making, where do you guys want to sit in the capital stack across these loans, I guess, first and foremost, and talk about the importance of the structure of each of the loans that you guys are making?
Yeah, so we're always in the senior position, and we're not in the senior position like BlackRock claims to be in the senior position on their private credit. So we don't really consider ourselves private credit because everything we do is asset backed. We're not lending on cash flows. We're not taking over companies when things go bad. We're taking over an asset, which, yes, you have to manage, but it's completely different to manage an asset than it is to manage a corporation, right? And we have very strict covenants. There's no other debt with our debt, so they can't have a mezzanine piece where the tail wags the dog, et cetera. So we're always sitting in that first lien position. And because we do everything in-house, we control the funding 100%. So unlike, again, a KKR, Blackstone, whatever, giving a private credit loan to a corporation or an enterprise where you're giving them the loan, we're not really we're doing renovation loans, and we're doing end loans typically for highest and best use. All the capital and all the proceeds we control. So if there is renovation work, we're actually doing the construction audits, we're paying the third-party contractors, et cetera. Think of it this way, because we went through 08 with everybody else. And what saves you is, again, everybody's a genius when times are good, but what saves you is having total control. Not only being able to take the asset back, but having the capital to finish the asset. So when you're looking at our lending platform, there's a lot of advantages because of the scope of the platform and how we're able to do business in this $2 to $20 million space. More importantly are the controls we have in place. And you'll see it's in his later slide. We underwrite to insurance standards. Yeah. So there's a lot going on here that is not typical in the private lending space.
Right, especially in the CRE bridge space, where we've seen a proliferation of funds over the last 3, 4, 5 years as banks have had to pull back for a lot of different reasons, which I think is pretty well documented. But again, one of the things that we want to do today is just deeper dive into the O companies and some of the core pillars that really distinguish the organization. One of the reasons why we were excited, when the opportunity presented itself for us to partner, you talked about all the aspects of underwriting, originating, underwriting, risk managing, servicing, it's exiting assets, and the benefit of all of those activities being under one umbrella. So can you talk about how the firm itself is structured and architected? Because that is a distinguishing feature when you compare bridge lenders. Because let's be real, Ray, there's a lot of firms that can go raise capital quickly, and they can rush into a space, and they can go out and start lending capital and using their balance sheet. But they're all set up differently. And so I'd love for you to distinguish and really identify for the audience of RIAs and folks listening the importance of understanding that and underwriting that, and how you guys at Oak Companies have set that up.
Yeah, I mean, this is so important, Andreas. I mean, it's a great series of questions you just touched on there. So all of these are not only done in-house, the origination. So we have our in-house originators who are employees. Okay, so if we originate a loan, even if we underwrite it and approve it and it stops performing, we claw back their commission. Oh, their part of their commission is held back, but then we claw back another piece of it. So having originators in-house that have accountability is important. Underwriting, we're very unique here because we underwrite for insurance companies, foundations, and endowments. And that's in a future slide. That is an incredibly high bar. So to have the ability, so we have 5 different insurance companies now that we're underwriting for, and to have the ability to do that, you not only have to have excellent underwriting, okay, and in our case, we have excellent technology to go with it. You have to have the infrastructure. So we're SOC 1 approved. Everything we do is auditable for our insurance companies. They have full transparency into our underwriting, all the policies, procedures. We actually have banks who invest with us as well. It is an incredibly high bar when you're dealing with institutions and foundations and insurance companies like that.
Yeah. And I want to click in on that real quick, Ray, because that's a distinguishing aspect here, the underwriting piece, and what you talked about with the insurance companies. And I think it's important to make sure the audience understands that the reason why being able to underwrite to the level of an insurance, let's call it an insurance underwriting capability and standard, and why that benefits, we believe, the wealth advisor, the family office, the individual investor, is because they have a lot of regulation when it comes to the assets that they're holding on their balance sheet relative to the policies that they're putting out for all different types of insurance, right? So when somebody comes in on the regulatory side to an insurance company, they're going to scrutinize, and we're seeing this with the private credit portfolios that they built. We're seeing insurance companies coming under more scrutiny around where they're putting specific loans. And so that ability to say, I need this type of an exposure, this type of an asset with this type of collateral, these types of performance characteristics, right? That has to go in this bucket. Not every manager out there can do that.
I actually have a whole slide on this, but since you're talking about it, think about it this way, Andres. So let's say you have life insurance, homeowners, auto, whatever.
Yeah.
So when you give them the money, it creates a liability.
Sure.
Right? So they have to have an asset to offset that liability that the same regulatory bodies that you're talking about approved. So when insurance companies, when we're going through that standard of the CM1 and CM2, which may not mean a lot to the folks on this call, it's the highest rating standard,
right?
Because they have to have commercial real estate loans that meet the criteria to offset that liability because, of course, they're going to have to pay out on some of the policies. That threshold, it's a 9-month underwrite. The banks that we've done business with was like a 1.5 years of them underwriting us.
Yeah.
Right. The insurance company was a 9-month underwrite of them underwriting us, not to count like another 6 to 8 months of just integrating the systems. They have full transparency into our systems.
Right.
So when you're talking about the RIAs, the insurance companies underwrote us. They've already underwrote us, right? So it is a very high bar that you don't see from a $500 million manager. You simply don't see it. And our technology, which we'll get into, it's in use, right? It's really interesting. I mean, it's I would say one other thing on this page that doesn't get enough credit is the servicing. Everybody says, "Oh, you collect the payments." In a commercial real estate loan covenant, we have an enormous amount of covenants, which are basically rules that govern the loan, right? For those who aren't real estate experts. The covenants could be 50 to 200, and they include everything like we get to look into their bank accounts. We have technology to do that, in addition to requesting financials, so we can reconcile what's real versus what they gave us. We audit, when there is renovation, we audit that construction with our auditors, and then we pay the subs directly and get the lien waiver releases. There's so much stuff like keeping insurance, keeping certain thresholds of reserves. There is an enormous amount that goes into servicing, especially when you're talking about servicing for foundations, endowments, and banks.
Yeah.
Insurance
And I
company.
think, yeah, one of the things that we really liked about it is, and we say this on our website for endurancex.io, is we're trying to find institutional quality asset managers and bring them to the wealth channel, right?
Yes.
So that doesn't mean institutional in the sense of they manage $500 billion. It means institutional quality in terms of the people, the depth of the management team, the processes, the rigor, the systems, the technology, how they can do all of these things. And so from an RIA standpoint, ultimately, I always have to remind myself, we have to explain this to a client. The client is not deep in the weeds a lot of times around the nuances of real estate and real estate credit. So what we as RIAs have to do is we have to be able to take bits and pieces that we can tie back to the manager and their story, these conversations, and then go and explain that to somebody who has ultimately hired the advisor as a fiduciary to make decisions around generating income. Because a lot of times they're looking to find alternative income. They don't want more exposure to the stock market, the bond market. They can't keep all their money in cash. So one of the things that I think is important is for you to also articulate when you guys were setting up the business of the O companies, you had to make some decisions about how are we going to serve these different types of investors. And obviously my audience and our audience at Gramercy with Endurance X is the RIA audience, right? So these are RIAs who are looking for alternative sources of income to sort of bring it all the way back. You have to make decisions about what are we offering? Our balance sheet? Are we offering solutions for insurance companies and endowments? Are we offering solutions for RIAs? And that's a lot of different types of LPs with different types of interests. But let's hone in on the RIA. When you think about, we can't get into the funds for compliance reasons, but when you think about how do we service the RIA and what are they looking for? What are you hearing relative to what you guys have built around what RIAs are looking for to solve?
This is a great question. So in the RIA base is our base. We built the company with the base coming from RIAs and some broker dealers. And the reason we did that, it allowed us to, as we take on institutional investors, not buy ourselves a job. We maintain the leverage because we have 8,000 retail investors through the channels, RIA channels, et cetera, broker dealers. So what we do to service, we're probably dissimilar from most. We do a daily webinar that actually goes through this deck in a very simple language, plain everyday language. So an RIA who hires us can say, Mrs. Jones, here's a deck, right? Mm-hmm. We don't talk about returns because our returns kind of range from, call it 8 to, high teens. Yep. What we say is we've got products for accredited investors, non-accredited investors, institutions, et cetera. We look at it a little bit differently and say, here's what you're investing in. We go through this. It takes about 18 minutes. So they've got something they can show Mrs. Jones with her and answer questions. And then instead of saying, we've got these products, we say, is Mrs. Jones accredited or non-accredited? And what's her risk profile, right? If she's got a very high risk profile because she's young and just starting out and she's non-accredited, well, she can invest in the company. It's high risk, right? But she's still senior to the management team, so still senior. Or if she's an accredited investor and just wants income, well, we have funds for that. And if they're a QIB and they're, 5 million plus, or what I think that's the threshold today, yep, they can invest in deals direct. So it's not what do we have from a product or security perspective, it's what's your risk profile and where are you at in your life.
Yeah.
But it starts with, this is the company you're investing in. Not only do we do the daily, we have downloadable materials to teach them about investing, our type of investing. Then we do quarterly updates for, even though we're not required to by law, we still do quarterly updates with what's happening in the portfolios, et cetera. So because we started and we're built for the RIA and the broker dealers, our whole basis is customer service. Yeah. And it's servicing and catering to that group, because here's why that group's so important. Without that group, the institutions end up owning you.
Mm-hmm. Yep. That makes sense. Well, and we Brian and I really like the parallels between when we dug in and underwrote the O companies and the offerings, et cetera. We really like the mirror commitment to the point you just made, which is that you see a lot of asset managers who have a comprehensive approach to originating, underwriting, risk managing, servicing, exiting. But then you say, how do you do that with investors? How do you take that same concept of managing your assets and apply it to investors? And it's almost like investors become an afterthought. And we, as RIAs, we recognize we don't have a job if we don't have clients that are willing to entrust their capital with us. And therefore, we can't go, then deploy it to asset managers. So, for us, it always starts with, helping the end client understand. And to your point, like you have to underwrite them and say, what are you trying to achieve? And that changes over the course of the client relationship, but it requires service. It requires a commitment. We can't just push product, because the right product is only going to be determined after you do that discovery work. But then the trick is to find managers that have this full comprehensive life cycle, and are truly committed to it over the long term, because they will hit bumps in the road. There will be times when, they're not able to deploy as much capital, and there's times to harvest when it's a great time to sell assets, or, for the borrowers to refinance. So all this stuff, is interwoven at the end of the day, I guess, is the best way to think about it.
100%.
Yeah. So a really comprehensive platform. One of the things that I think is important to talk about is where you all sit in terms of why, the insurance companies, right, on one side, and the banks on the other, who were the ones supplying the capital, to the small balance CRE borrower, why those two forces pushing like up against each other creates, I guess, an opportunity, or why banks stepping back created the opportunity for you to step in to provide capabilities that the insurance companies needed. There's some really big numbers here on the chart, but I want to let you talk about this connection.
Yeah, so let's take it one step back further. You mentioned all these other private credit folks like the Blackstones, the KKRs, et cetera, and they're just asset aggregators. So they're aggregating all these assets. Some of them have offered some of that capital to us, but doing business with them is very difficult unless you want to become a high paid employee for them, basically. So what we did is we said, okay, it's an enormous market. Let's hit a sector of the market they can't hit. So it's a $4.8 trillion market, right? And when you think about it, banks have pulled back because of, Dodd-Frank and regulatory headwinds per se, with all the various administrations. It left that gap that I was talking about. Like, the insurance companies need these loans. They can't underwrite a $2 to $20 million loan. Some insurance companies underwrite the 50 and above, right? Yep. So they need these to asset liability match, as we talked on. So Oak is filling that gap. As banks left, insurance companies still need it. And when I say insurance companies, foundations, endowments, et cetera, because if you look at the right-hand side, there's a $300 billion commercial real estate lending gap every year. And wow. None of the people you talked about are doing the 2 to 20 million. Right. And the 2 to 20 million is what keeps America going.
Yeah.
It says right there, it's incredibly fragmented, and we have defragmented it with efficiencies. And with that comes additional yields, and with those additional yields comes benefits to our investors. So yeah. That's the whole banks left, insurance companies stayed. They left, but they still need it. They still need these loans.
Yeah. They've moved for different reasons. They've moved to a different segment of the market. All those sub $20 million borrowers that are your grocery anchored retail strip center down the street, or the Class B multifamily that's doing upgrades to the 50 or 250 units, right? Those borrowers need access to capital, and these communities want to continue to invest, right? And if you look around at any community, it seems like, I'm in the Sun Belt, right in the Southeast, like it, we got incredibly, built up when it came to the really shiny multifamily in Atlanta. I think Nashville's going through this now with maybe some oversupply, Austin with some oversupply. that may not be what we're talking about here. Maybe we're talking about like the stuff that's in your neighborhood where the borrower needs $14 million to go do something, and the people in that community really will benefit because it's that grocery anchored retail strip center, or it's that small apartment where working class families, are relying on that because it's on a bus route next to a local school, right? So this is a bigger story than just your shiny Class A glass towers that tend to get all the news coverage.
Andres, I don't know if the gravity of what you said is going to hit everybody, but when you think about all these shiny Class A's, when there's a market correction, there's always a major market correction. It's just a matter of how many years. All those people in the A's move to the B's, right? Who can't afford them anymore. A Class A apartment now here where I'm at in Michigan could cost $3,000 to $4,000 a month. Mm-hmm. The stuff we lend on typically is $1,500 to $2,200, right? It's half the cost. Now, mind you, it doesn't have the same amenities, but that grocery store, they need that Aldi's. They need that Harris Teeter, right? So they need that.
Yep.
And not discounting mobile home parks.
Yep.
They're fantastic investments. They are absolutely. The point here is we not only lend all that to the institutional level that meets the insurance, foundation, endowment, et cetera, but when something goes wrong, if it goes really wrong, of course, we try to help them with a workout. If not, we end up owning it.
Yeah.
Right. So it's not horrible. And when we say we end up owning it, us with our investors.
Yeah.
It's, a grocery anchor is not going to go away. Class B apartments are not going to go away. They're not like the A's where people start going down. Right.
That's right.
Mobile home parks, they're going to pay that bill. Right. And if not, you've still got the pad. So we're very defensible in what we're doing. And again, I think the next slide talks about our growth. It's been very conservative how we've grown. We've grown by basically reinvesting in the company without taking any private equity money, without taking any corporate debt. So we have no corporate debt, no credit lines, nothing. We grew it just by reinvesting in the company, hiring amazing people to help us grow the company. It is not common in today's world.
No, you see, you see a lot of different models to get to scale quickly, so you can go, if you again play with the big Wall Street firms. One of the things that we're highly convicted on, I said this earlier in the conversation, is the idea of building a platform of managers where they're institutional quality. And I'm okay using the term. I'm trying to make sure I don't ever offend our managers, but they're the small and mid cap of the alternative asset world, and they're okay with that because they know that their strategy, they can actually go and touch and feel the assets. They know that the size of the funds that they're raising by design are going to generate higher returns because they're not trying to be these open-ended asset gathering monolithic vehicles that you see have proliferated with the evergreen and the interval and the tender funds, where you're trying to gather billions and billions of dollars, and returns are going to suffer accordingly. And so we're excited about identifying managers, but one of the things that we also really, really are focused on is making sure that those managers have really, really good underwriting controls and really, really strong people when it comes to making the investment decisions. Because let's face it, in a lending situation, right, you're putting the capital back, you're getting some principal and interest, right, maybe some points or fees, but it comes down to the quality of the collateral at the end of the day, right? The quality and the characteristics of the collateral. And I think that you're lending into an environment, if you look at the slide, where there's hundreds of billions of dollars of this flow to be able to pick and choose from thousands of potential opportunities. Is that fair to say on an annual basis?
We see just under $9 billion a year of new opportunities. And
Wow.
We'll talk about the tech in as much detail as you want.
Yeah.
It allows us to be incredibly selective with the deals we want to take.
Mm-hmm.
Right. So we have just an opportunity that other people don't because of our technology. We can screen $9 billion worth of deals more efficiently than some even of the large cap folks we keep talking about. And some of them have asked if we would license our technology to them. And the short answer is no, because they have capability, they have more capital than we do. So we don't want to disadvantage ourselves.
Sure. Yeah. Well, I think it's a really important slide, like the market. Let's talk about the trajectory of the firm, right? So the O companies today is in excess of $500 million of originations, going back now close to 10 years. But it wasn't always that way. And, one of the things that we are biased to, like I said, I've said small, I've said, the managers that are touching these assets and that are able to articulate that advantage to an RIA. But the fact of the matter is that not all firms survive that first 5 years, right? They run into trouble. They whether it's, they can't deploy the capital, they can't raise the capital, they deploy the capital too quickly. All sorts of things I've seen in my nearly 20 years of doing alternatives in private markets. And so there's a huge aspect to finding managers that have a defensible moat. They're willing to adapt. They're willing to show agility when markets change. Their strategies are dynamic, which I think you articulated some of those things.
Sure.
But you have to think about this one loan at a time. And you actually have that here. So I want to let you talk about it. How did you guys grow from, where you started in 18 to kind of where you are today, where you're really trying to hit your stride and scale up?
Yeah. So if you look at this is not popular. When folks are growing their business now, they take a bunch of private equity money or load up on corporate debt. This, I think I've touched on it, is we did it the old fashioned way, reinvesting capital, hiring the best people. We did this, like I said, it's literally one loan at a time. Look how steady it is, even through some of those turbulent times, without a bank charter, without a public balance sheet, and always sticking to that $2 to $20 million. We're just very conservative, Andrea. So even still, I told you, we don't have a corporate credit line. We don't have any debt at the corporate level. The intention was to build an incredible base and then scale. So that's what we've done here. We're now to the point where we're going to start scaling, and we're looking at some larger investments, and we've got the pieces in place to handle it. The whole point when we were putting this particular side together, I wanted to show you and the folks that you communicate with on a weekly and monthly basis that it was done the right way. It was done the right way, the old-fashioned way. Again, not the most popular way, but if you had to look at a company and say who's going to be sustainable, who's not going out of business for our investor, and who has that institutional backbone, that's what we were trying to convey here.
Yeah. And I think it's fair to say that, right, nobody on our side, and I don't think a lot of the RIAs out there are sitting around saying, hey, we're big enough, we don't want to grow anymore, right? I mean, they might be thinking about an exit, or they might be thinking about efficiencies, but I think all of us are in the business, in the financial markets, in the capital markets, and saying, hey, bigger is okay. I think that the nuance there is at a reasonable amount of growth where you can handle the influx of assets, where you can deploy sticking to, if you will, your knitting, right? So no, I don't think anybody's saying, hey, you can't go do a loan of 22 million or 30 million, right? Those opportunities are going to come as you become more well-known, and as those borrowers get bigger, right? They're going to want to come back and say, hey, we want to go, but you now have multiple programs to put those assets into. You've talked about this already, so we'll maybe spend a little bit here, but the notion is insurance companies have underwritten you. You have multiple insurance relationships. Why should an RIA care, I guess, would be the question, to reiterate.
Look, we've seen post-COVID RIAs and broker-dealers get sued more often than I'd like to admit. Maybe I shouldn't even be saying this. We build everything for defense. So we've been underwritten by some of the most largest institutions in the country. We've been underwritten by 5 insurance companies now. We've got a significant number still underwriting us. Foundations and endowments. I told you we have a bank that has invested with us too, pro rata pari passu. I think for an RIA to look at us and say, okay, because they could probably say the same thing about Blackstone, right? So Blackstone probably has said the same thing. The difference here is we've done it at that kind of $500 million mark, and we've done it in a space that we've chosen to be backed by hard assets along the way. So there's the vast difference between doing what we're doing and what the large cap private credit guys are doing, we're doing the same type of institutional due diligence in this $2 to $20 million space. So that should give them a lot of comfort.
Yeah.
And in addition, like our insurance companies, it should give them comfort knowing that there's a hard asset backing it. It's the probability of it going to zero is if we have a zombie apocalypse or something, right? Like it's not going to zero if the land is still there.
Yeah.
It's worth something, right?
Yeah. Yeah. And I mean, I think the other thing that's important is for the folks that are listening, when we talk about asset backed and asset based strategies, at Gramercy, and certainly the firms that we've elected to partner with at Endurance X, one of the things that we're really focused on is our underwriting of those respective managers and what their controls look like, because there's been this big proliferation of credit and non-traded credit, right? So private credit is not all the same. I talk to your colleague Brooke about this regularly, that when people hear credit and private credit, some folks are just not distinguishing between a cash flow lender that's lending to middle market, large and small middle market, sponsor backed or non-sponsor backed companies that are generating cash flows in those businesses, and they're paying back those loans from cash flows. That is a dramatically different underwrite and profile, and those are largely the ones that have been in the news, the BDCs, than an asset-backed real estate credit small balance lender like an Oak, where you guys are literally able to manage the entire real estate life cycle, right? From underwrite to servicing and the risk management and all those aspects, where if something did go wrong, not only the structure protects you, being in the first lien senior secured position, but also if you needed to take the keys back, as they say, and manage the real estate asset, you have the team led by, Matt Webster, who's managed hundreds of billions of dollars of real estate for large global organizations, and the team that supports him to be able to do those workouts.
100%.
Yeah.
And Matt's later here in the deck, but head of global real estate for HSBC for 7 years. He was with them for 12 years.
Yeah.
He's got a very colorful background of success across firms that everybody knows here, that would know here. Think about a $500 million manager getting somebody like that.
Right.
He wouldn't be here if there wasn't tremendous opportunity.
Yeah.
And he wouldn't be here if the machine wasn't built right.
Yeah. For the growth. One of the things that I've learned more about, and I think that you guys will, probably be able to share more of this, in one-on-one conversations with folks. And certainly if you're interested in learning more about Oak, you can do so by checking out their tile in the EnduranceX.io website. But you can also reach out to me, and I can introduce, Ray and his capital markets team. But one of the things that I've learned that I think it would be great, to hear you talk about is the platform, and the investments that you've made around technology, and how that is a game changer for you guys relative to the opportunity set. Because it's one thing to see hundreds of billions of dollars of real estate. It's another thing to be able to do something with it and actually screen it and decide, is this something we want to spend time on? And, I think it'd be great if you could spend a couple of minutes just talking about, like, what was your approach here? What were you guys trying to solve for? And maybe most importantly, like, how does an investor benefit, listening with all this technology that you've invested in?
Yeah. So thank you, Andreas. So Lens is our initial analysis of any loan that we underwrite. It's our underwriting platform. Is AI enhanced. Yes, we use Claude Code, but it doesn't run on the internet. It can run without the internet. So it is AI enhanced. We've been working on it for about 5 years. It basically, we explained this to maybe the country's third largest investment manager 2 weeks ago. We showed them our underwriting, which is all insurance grade. So we showed them our underwriting workbook. We showed them our underwriting platform, which basically runs the analysis that is in our initial underwriting workbook, and it puts it in all of our systems. So here's how we explain it to them. Think of us having 20 Goldman Sachs analysts on demand to review every single deal that comes in 20 Goldman Sachs analysts for every single deal. So if we have 10 deals come in today, I said, it gives us that kind of scale. And we actually told them, and we said, it takes typically 40 hours to analyze a deal because we do the same quality of underwriting as they're doing on the $200 million building, 30 to 40 hours, right? To do a full analysis of the deal. So we can actually do it in about 20 minutes with our platform, 15 to 20 minutes. And it's fully auditable. It's currently being used with our insurance companies. And this isn't dumping a bunch of documents into Claude. This is a full-blown underwriting engine running with or without the internet. And I think when you see it, if there's any real estate critics here, we would love to do a demo for them within your groups, or anybody who really understands the real estate lending space. We would love to do a demo for them. But it's basically allowing us to take that $8 to $9 billion a year and to do an analysis on it, a very deep analysis, which does a couple things. One, now we can pick the cream of the crop.
Mm-hmm.
Right before the platform was done, and again, this has been in process for 4 or 5 years. Before the platform was done, you kind of eyeball, or the originator eyeballs which one they want to do. Now every deal we run through here, and we've got 15,000 deals that are the basis of this, right? That we've used as the basis of this. Our HUD and FHA qualifications are in here, so it's incredibly comprehensive. But the end line here is, it allows you to defragment this fragmented market that we play in. So it allows us to do what the big guys can't. Here's the most important thing too, though. The second most important thing. Let's say you had 2 deals going and you had 10 Goldman analysts on each one. You'd have 20 different analysts and they all have a slightly different bias. This removes that. It gives you one quality standard, no matter what you're doing. Again, all auditable, all being used with our insurance companies. But Andreas, the most important part of our technology is that, one, now the humans that are actually doing the underwriting, so the guys actually doing the underwriting after all this analysis, can spend more time on a deal. They can spend more time focusing on the areas that pop up as a red flag. They can spend more time on their gut instincts. They can spend more time. We do a physical site inspection on every property. This just was not possible. Right? So it gives us an incredible advantage. And for the folks who do invest in the company itself, think about it. It allows us to scale without adding significant headcount. But more importantly, the people who are here, we can pay to have the best people here.
Yeah.
So I said a lot there. And of course, you can tell I'm excited. What we've told the largest firms who have given us money and who are considering giving us money, we said, bring your toughest real estate critic and have him do a demo with us. Mm-hmm. That's the litmus test. Bring your toughest real estate critic and we'll do a demo.
Yeah, well, I'll go a step further as far as the RIA audience. I mean, for those of you that are interested, I'll make this offer sight unseen. I think Ray, has demonstrated, throughout the call today that they're open, transparent, and they want to build relationships. So for those of you that are listening or do listen to the replay on YouTube or on our podcast, I think this is a conversation that benefits from being able to look at the content on a screen. But if you guys are interested, reach out to me and we'll set up a demo and we'll go through that. And you'll be able to take away your conclusions. But I do invite you to bring your real estate critics, bring your folks that touch real estate asset managers or real estate funds, so that they can see this, because I do think that a lot of people are hearing about technology and how it's informing the investment process, but they're hearing about it in the context of soundbite or a Wall Street Journal article or a news clip on CNBC. They're not actually getting to see it. And so this is an opportunity to see it and see how an asset manager is taking thousands and thousands of deals that are coming in, and then on the other side, actually get it to a committee decision where humans are having to vote yes or no. And then are we making the loan? And then are we making the loan on what terms? Because ultimately, I have to keep bringing it back to the RIA has to go to a client, Mrs. Jones, and be able to explain why we want to take a portion of the capital and we're willing to tie up some capital for some time, right? And deploy it into small balance CRE lending with this manager, right? So it's for me, it's so important for the RIA to have, sound bites or takeaways or stories or examples of like, hey, Mr. and Mrs. Client, I saw this firsthand. And let me tell you, this is the stuff you're reading about, but this is a manager that's actually doing it. So I would encourage you folks listening to reach out to me, and we can set those demos up so that the team at Oak can really show off their technology.
Yeah, this is how
yeah.
AI is actually making money.
Yeah, right.
So this is a little bit salesy. This is talking about the scale of the company and how we plan to do it. So we don't need to spend a lot of time here on Andreas.
Yeah.
But we're basically scaling the company. So everything's built, everything's operational. It's all generating revenue, right? So the origination, the in-house underwriting, the asset management lens, which we just talked about, the insurance relationships. So that's all we're doing to scale. And as we scale, we will add credit lines. Right now, we don't have the most efficient. So typically when a loan pays off, we just re-lend out the money, right?
Yep.
With credit lines, we could bridge that gap.
Yep.
Because we're so conservative in the geopolitical issues happening around the world and the administration changes, et cetera, we've just took the road of caution.
Yeah.
But there's a lot of opportunity for growth here. And with our technology, there's real growth that continues a profitability trajectory that doesn't come when you scale. So we're not only built to scale, we're built to scale while maintaining that growth trajectory and profit trajectory.
Yeah, fantastic. One of the things that I think is the cornerstone of where we start every conversation, at least for us at Gramercy and Endurance X, and I would imagine you have a process when you encounter a new borrower that's reached out that wants to work with your institution, with the Oak companies, and they've got a $10 million financing need. People still matter in this day and age, right? Contrary to what what we read and hear about how AI is changing everything, and I think it's definitely bringing some efficiencies in, but the asset management business is still largely a people business. It's relationships, it's networks, it's what's their reputation in the market, can they execute, will they execute? So I want you to maybe take a minute and talk about, the team has been referenced multiple times, and if one thing I felt very comfortable about with the Oak when we first underwrote is I said, gosh, they have a lot of senior people relative to the size of the firm, which you don't see a lot of times, right? You sometimes see one or two principals and then a couple of more junior people, and maybe the middle needs to be deepened or the bench is not very deep, and there's some key person risk, right? With a small manager, but that's certainly not the case with the Oak companies. So talk a little bit about the team, how you've built the organization out, why you have the team that you have, and maybe most importantly for RIAs and investors, how do they benefit from all of these people, right, that you've assembled on one management bench?
Yeah, there's so many good points in there. So you cannot scale and do business with institutions, foundations, and endowments without a deep bench. Think about it, we're $500 million. We recently won a couple $100 million insurance SMA. And I said, so why did we win it? And they said, there's two reasons why you won it. One, you helped those investors out that you didn't actually get in trouble. They said, they spent 9 months looking for a manager to invest with. They said, that to us is the single most important piece of why we're doing business with you. They said, the second piece here is, you've got the team, BlackRock, Goldman Sachs, Morgan Stanley, Nomura, HSBC. Andreas, I'm the only cowboy. I'm the entrepreneur in the group that hasn't been at a big firm. All of these guys, it's so hard to find the people that are on this page. It's hard to find somebody with large cap experience who can operate as what was an emerging manager. We're just past that now, right? But what was an emerging manager, to find somebody that's doing that, because like Matt Webster, when he first started, was pushing spreadsheets, right? Yeah. He was helping tweak the underwriting model. He was doing these things that you just don't see happen. So the team, Matt, I focus on Matt because Gary Bechtel is our chief executive officer. He and I are the primary partners in the firm. Matt's going to be the next CEO. So we pegged him as CEO in waiting. Everybody's like, so Ray, why wouldn't you do it? I'm like, because he's the best guy for the job.
Mm-hmm.
Gary's not going anywhere, but I'm telling you this because this is how you plan years ahead to ensure the company's stability.
Yeah.
Right.
Yeah.
So I could give accolades to the teams. They're all brilliant. Tom's brilliant. Like they're all brilliant people. But the point here is we're thinking about the future, even when nobody else our size is thinking like this. We've got redundancy recession planning across the whole firm. We've got somebody to clearly operate every swim lane and be responsible for it. So as we grow and scale, there's no, oh crap, who's doing this? We've got the team already doing it.
Yeah. And one of the things that we really, dug into was what is the experience lending across market cycles? And, across 8 market cycles, the team has gained experience, right? I mean, I've been in the industry since 2006. So, one thing somebody told me very early on is, you need to go through some crisis in this industry and come out the other side of it, because that's the only way you will get credibility in a room, is how did you navigate through when things didn't go well? And we keep talking about that. And I think it's important to maybe come back and circle back to that as a finishing point before I let you make some final comments, Ray. Is everybody can look at what happened in any of the asset classes that had their moment, right? Venture capital, leading up to in the late 90s, and then here up to 2021, private credit post GFC up until, a year or two ago. Maybe it'll be CRE credit, right? That in 3 or 4 years, the shoe's on the other foot, or asset based or asset backed, right? Hedge funds had their moment. I worked in that business, and still have a lot of exposure there. It was hard to sell a hedge fund 5 years ago, 6 years ago, right? Because everybody had gone passive. And so my point is that the comment about having a team that's gone across cycles and has navigated it and gained experience is a huge benefit to have on your side when you're thinking about deploying capital, because that is wisdom and experience gained from, having to put capital at risk, make hard decisions. And in some cases, like we've talked about, roll your sleeves up. And we love managers that are willing to roll up their sleeves and get their boots dirty and get back to Main Street and fix stuff when it doesn't work.
Yeah, Andreas, so we didn't talk about this, but this platform was built to ballast the market cycle. So the acquisition, the bridge / transitional, what I didn't tell you is we do mini perm for some of our insurance companies and then the permanent FHA. So not only does this team have about $25 billion in private, commercial real estate lending and well over 150 years. This is just the management team. In addition to that, the whole platform was built to bias. So when so because there will be another market correction and there will be another Great Depression, that's what we're built for. We want to make sure that the whole platform bias. So it's not only the experience, but it's the experience of what's been put in place, the spine of the company.
Yeah.
That's what that 8 market cycles get you right there. Yeah. How we lend, right? How our controls and our servicing are.
Yeah. And those things come into play when you hit troubled waters. So I know we have a few more slides, which we'll finish up here. This is where I think you guys talk about the revenue line. So we'll skip through that. But one of the things I think we should wrap up on is how Oaks investors and maybe we talk about this at a more general level, but one of the things that we were really excited about in partnering with you is that we felt like we had identified a company that started with quality people. They had been through a lot of experience. They had demonstrated integrity of addressing some of the challenges with some of the predecessor loans that another team had originated and addressing that, right, which you just spoke to. But then also we're architecting and building a platform for growth and for scale to take advantage of opportunities. Sure. So they got the call. They got the first call, right? And that's what you want. So talk about investors, go back to serving the RIA and how they're benefiting from all of these things.
Here's what I'm going to say to that, Andreas, is we were built to build an RIA's business. You can go into Mrs. Jones and say, I've got something that's institutional quality. Okay. I've got something that's been vetted that insurance companies are actually using. I've got something with a management team as good as Blackstone. Well, we think so anyways. And I can serve you, Mrs. Jones, whether you're accredited, whether you're non-accredited, whether you're a super accredited investor, and hence even some RAs have foundation and endowments relationships.
Sure.
I can service you no matter which one of those categories you fall into and which risk bucket. We have rated product for somebody who wants a 7% return, super low, risk it. And we have all the way up to the incredibly wealthy investor who wants to directly participate in a loan with us. So when you say close this out, my closing is your RIA should be calling you to say, okay, look, I've got a book of accredited and non-accreds, or even accrediteds and foundations and endowments. Here's the risk profile. Put them on the phone with Brooke or Kevin and yourself and say, okay, what does Oak have and how does it fit from a risk perspective?
Yeah.
The return's going to be the same. If you want super low risk, you're going to get the 7%, right? If you want something that's paying north of 15, you're going to have to co-invest in a deal, right? Yep. So that's why, all of these investment opportunities live behind a Chinese wall. You're just not allowed to talk to them about them. And we don't really care about them. What we care about is, what does their business need and how can we fill it? And if we can't fill it, then move on, right?
It comes down to solutions at the end of the day. When we set up Endurance X, it was all about trying to be a solutions provider to the independent advisor who had really, like me, my journey in this industry is, I saw this proliferation of technology and alternatives converge. And there's a couple of really great platforms out there that I think originally started out doing what we're doing, which is we're looking for talent. We're looking for great teams that are solving problems for RIAs. And then we're going to put their offerings in a market and we're going to make them available with technology at scale. And I thought that makes a lot of sense. When I was on the GP side of the business, I thought, I want to be on that platform. Well, now you look up 10 or 15 years later and it's all the mega managers that are gathering mega assets. And I'm saying, who's actually rolling up their sleeves, getting their boots dirty, and is that small growing a manager that's in the first third of their life? I want to find them there because the research shows the returns are better. The alignment's there. We're not getting fat and happy on the management fees, right? So they care about the carry and they carry about the promote, and that's how they're recruiting and retaining their best talent. So for all those reasons, we set up Endurance X to go find the Oaks of the world and hopefully be a part of that growth story. But it does come back to the RIA, and the RIA's client has to understand the story. So we are delighted to be in partnership, with you, but it starts with education. It continues with, converting belief to trust. That's a process. You've built a team. We are glad to be a part of helping get that story out. But I love to leave our clients and partners, our managers, with a final comment, right? Because we put this content out there. It's not self-serving, right? We want to educate the market around ideas and strategies and managers that we think are doing it different and better, not just different. And so we're excited to facilitate those demos, those introductions, those calls. But I want to give you the last word, Ray. As the president and chief strategy officer, you sit at a really unique time and perch at your organization with a great bench. There's a lot of really interesting things and partnerships you've already achieved, but it sounds like you feel the future is still even brighter, which I'm excited about. And so with that, I'd love to leave you with the floor for the final comment.
Well, Andres, I'm not the sales guy. In fact, I'm the brutally blunt. What I would say to all the RIAs out there is dig in, learn about Oak, talk to you, Brooke and Kevin with you, and help us discover what your business needs and see if we can help fill that gap. If you don't invest, you don't invest. Like I could, I'm not, and I don't mean that flippant. I'm just the guy that says, we don't want you to invest with us or be part of the team if we're not solving a major solution. If you've got a better solution, that's great too. And I know that seems almost counterintuitive, but it's learn about Oak, learn what we've done, learn where we're growing. If you're into real estate, you will definitely want to see a demo of our technology because you'll find it interesting. So with that, I'll probably just say thank you and encourage them to discover more about Oak. That's the closing statement.
No, that's great. Well, I appreciate your time today. I know, we went a little long, but the benefit of this content is, again, educating advisors, educating, folks that are out there building a practice, delivering solutions to client, bringing ideas forth. So please reach out if we can help facilitate those connections and introductions and webinars. With that, I want to thank you, Ray Davis, President and Chief Strategy Officer of the Oak Companies. There's a lot of really interesting things happening in real estate and real estate credit specifically, which we articulated today. We'll make sure to put contact information and access to the slides in the chat comments. But that's where we'll leave it today. So this is Andre Sandate from Gramercy Park Wealth Advisors, Endurance X, and Ray Davis from the Oak Company signing off. Thank you.
Andres. Thank you.
Thanks.